As part of First Asset's commitment to providing advisors and investors with compelling investment opportunities, we'd like to outline in a few short slides over the next 4 to 5 minutes why we believe value investing is set for a resurgence and why now might be an excellent time to buy on weakness. Before we begin, though, we ask that you please take a quick moment to familiarize yourself with the following disclaimer and be aware that this presentation is intended for informational purposes only, and it is not and should not be construed as investment advice to any individual. Individuals should seek the advice of professionals as appropriate regarding any particular investment and read the prospectus before investing. 2015 performance results in North American markets were largely characterized by investors' appetite for large-cap growth stocks. At the other end of the spectrum, we saw value stocks fall out of favor, particularly those of the smaller cap variety. What we have to remember, though, is that whether it be a particular factor, market cap, region, or asset class, performance is cyclical and it differs depending on the current market environment. Our value ETFs here at First Asset are based on proprietary Morningstar construction methodologies that tend to have a structural bias towards smaller and mid-cap stocks due to the significantly larger opportunity set, as well as the empirical data supporting the size premium. The number of small-cap stocks trading on the market is in fact far greater than the number of large-cap stocks trading, which inevitably leads to small and mid-caps dominating the buy list. As you'll see here, the best performing factor does change from year to year, but value has regularly been at or near the top, and we believe it is now particularly oversold and should rebound in relatively short order as it has in the past. If history tells us anything with regards to value investing, it's that periods such as this, where value is underperforming, are usually pretty short-lived and are typically followed by some sizable spikes of outperformance that have much longer lifespans. Plotted on these three charts are the rolling one-year excess returns for Morningstar's Canada Value, US Value, and International Value indexes. What you'll notice in each case is that the largest and longest instance of underperformance was during the financial crisis of 2008. But otherwise, these strategies have pretty consistently been above the red line or in beating the benchmark territory. In fact, they've outperformed their respective broad market indices in 75 to 80% of all rolling one-year periods dating back to their inception. So subscribers to the idea of mean reversion, that is, the tendency for an investment to gravitate back towards its longer-term average, should take comfort in the fact that we're now in the midst of what has been a historically drawn-out period of underperformance. And we feel that this is potentially indicating we're getting much closer to a rebound. Further supporting the thesis of a value resurgence is an increasing trend showing that U.S. value outperformance, the blue line, has become more and more correlated to the well-being of the S&P 500 index, the red line. In other words, value has outperformed when the market itself has performed well. So if the U.S. market is simply in the midst of a very normal correction rather than a recession, the recent correlation indicates there's a fairly high probability that as the market rebounds, value will outperform once again. Another way of looking at this theory is from a small mid-cap perspective. What you can see with the blue shaded periods here is that when the S&P 500 rebounds off of its lows, the U.S. value strategy posts some significant outperformance. Based on the previously mentioned structural bias towards smaller cap stocks, this strategy has not only benefited from depressed value stocks rebounding off market bottoms, but as well from smaller cap stocks that have tended to lead larger cap stocks coming out of rough market environments. So while small cap and value stocks have worked against investors of late, the flip side of that should be the case as the S&P 500 resumes posting some decent gains. Value investors are now being presented with some pretty compelling valuation figures. With U.S. value currently trading at a PE multiple of only 8 times, not only is it well below its longer-term average, as you'll see on the left-hand side of the screen, but it hasn't been this depressed since the 2008 financial crisis. And when looking at valuations relative to the broad market, U.S. value is roughly 60% cheaper than the S&P 500, and that's a level we haven't seen since 2003. Interestingly, when the discount, as represented by the solid green line, has been above its longer-term average of 37%, the dotted line, the subsequent one-year average outperformance has been 17.5%. You heard that right, 1,750 basis points greater than the S&P 500 index. So while markets have been volatile and asset values have deteriorated, we would encourage you to remain objective with your investment decision-making process rather than letting your emotions take over. After all, times like these have historically represented excellent buying opportunities, particularly for investors with medium to longer-term time horizons. Now, while we've just mainly focused on U.S. value, First Asset does have a suite of currency hedged and unhedged ETFs across geographies that provide excellent options for capitalizing on a value resurgence. As of the beginning of March, we'll also have a global value mandate that consolidates our Canadian, U.S., and international value strategies into a single ETF portfolio. Thank you very much for your time. We encourage investment advisors to contact us to learn more, as well as to receive complimentary analysis, comparisons, and portfolio building recommendations. Individual investors, we encourage you to speak with your advisor about how to incorporate First Asset's suite of low-cost value ETFs into your portfolio. Thanks again for your time, and we look forward to speaking with you further.